Good morning, one and all. Today, as a team, me, Sandeep, and Sangeetha, we are going to present about Barclays Bank capital risk. And first of all, we have to know what is Barclays Bank. It is a public limited company established in the year 1690 in London, founded by John Freeman and Thomas Gowl. The name Barclays came from the Freeman's son-in-law, James Barclay, and in 1896 to 2008, what are the bank major achievements we are going to discuss? 1896, Barclays Bank has 182 branches with 26 pounds million deposit. In 1925, mergers with Colonial Bank, Anglo-Egyptian Bank, and National Bank of South Africa. 1926, total 1837 branches it has been, and in 1981 it is the first foreign bank to raise long-term capital at US, and in 1986 the first British bank listed to on Tokyo Stock Exchange and New York Stock Exchange. In 2003, acquisition of Banco Saranganzo, Spain's largest private sector bank. In 2005, acquired a major stake of ABSA Group Limited. 2008, acquired Lehman Brothers Investment Bank and capital marketing businesses. It is the best achievement of the Barclays Bank which I have ever seen. And Barclays Bank has retail, commercial, and investment banking. Europe, USA, Latin America, Africa, Caribbean, Asia, Middle East, and Australia were the clients of this bank. And now we are going to discuss what is capital risk. The risk an investor faces that he may lose all or part of the principal's amount invested. Capital risk is the risk that the group has insufficient capital resources to meet minimum regularities requirements, maintaining adequate capital resources, support its credit rating, support its growth and strategic option. And next is risk factors. Macroeconomic changes, extent of sustainability of economic recovery, dynamics of unemployment, impact on delinquency and charge off rates, speed and extent of possible rises in international interest rates, possibility of falls in residential property prices, impact of declining sovereignty credit ratings. And next part will be continued by my team Sangeetha.
There are some more points to macroeconomic factors, like if a company having business in different sectors fails in one business, then there are chances of name crisis, and that will create capital risk for the company. It is especially crucial where economic downgrading has quite an impact on the credit position. Inflation and economic condition also have impact on capital risk. Again, changes in the foreign exchange rate has huge impact on capital risk. The hard currency and soft currency also are deciding factors. Credit risk weightage asset ratio and the credit rating also are crucial for increase and decrease of capital risk. If the group's capital requirement increases due to some reason, it will automatically increase the risk factor. Due to turmoil in Middle East and North Africa, that is the oil and petroleum exporting countries, the prices of petroleum and gold will increase, making changes in the currency value, that is appreciation and depreciation of currency. Liquidity of the market will make the risk factor go high as well as the profitability. Higher the liquidity, higher the risk, higher the profitability. How the investors will take advantage of this liquidity and profitability will depend on the risk-taking attitude of them. Again, the increasing competitive banking culture, the fees and commissions are being reduced, which makes the capital risk higher. There are some other reasons like regulatory changes, which includes Independent Commission of Banking, Recovery and Resolution Plan, Dodd-Frank Wall Street Reform, and Consumer Protection Act, which is called DFA, etc. At Barclays Capital, there are main 4 points. Like one is risk management plays a central role in all major decision-making processes. They incur different types of risk in their day-to-day business, and there are credit risk, market risk, operational risk, and there are their internal risk management department called GFRM. They take care of all the risk evaluation and strategy making. There are capital risk management. They have their centralized capital management model, and they consider both the regulatory and economic capital. In Barclays capital management, they have some objectives, like one is maintaining sufficient capital resources and to maintain minimum regulatory capital requirement, or we can say it like capital adequacy ratio. Then they have some other points to cover: to maintain sufficient capital resources, to support the group's risk appetite and economic capital requirement, to support the group's credit rating, to ensure locally regulated subsidiaries that can meet their minimum capital requirement, and also to allocate capital to businesses to support the group's strategic objectives, optimizing returns on the economic and regulatory capital. So we can say that they have their internal target for GFRM as changes in forecast demand for capital caused by new business opportunities, that is mergers and acquisitions, flexibility in debt capital issuance and securitization, and possible impact of stress scenarios including number 1, changes in forecast demand for capital, number 2, changes in forecast profits, and number 3, changes in capital resources and forecast demand due to foreign exchange rate movements. So we can say as a conclusion, as Barclays, it's such a big society that it's too big to fail. So as a customer, we can conclude that Barclays is very successful to maintain their risk within a certain limit, so that our money, whatever we invest there, those are safe there with Barclays. Thank you very much.